All right, so dynamic scoring is that all of these cost estimates are passed with certain assumptions about what's going to happen in the economy. We're less than a week out from getting the updated budget and economic outlook that includes the budget baseline as well as CBO's forecast for what's going to happen to the economy. And that macroeconomic forecast is held constant under conventional scores. So often you'll see the contrast between static and dynamic scores. When they talk about static, CBO and JCT have come back and said, look, we assume a static score means that there are no behavioral changes of any kind. Effectively, like often what they do when they're calculating changes in taxes is they've got tax data for everyone. So they understand how much you work, how much you derived income, the basis for it being taxed. And if they want to make a change to the tax rates, they then see the same amount of income that you chose to earn and apply a different tax rate. That'd be a static score. A conventional score would recognize that at the individual level, if your taxes go down, you may like to work more, but it won't recognize that there's any change at the macro level. So the economic forecast contained in the budget and economic outlook is still the same, but they may recognize these micro level behavioral changes, recognizing that at the individual level, supply and demand still change. You still need to think through the second order effects and recognize that if you tax something, you get less of it. If you subsidize something, you get more of it. The dynamic score, though, relaxes that assumption about the macroeconomics. So it recognizes that it's not just individual labor supply changes. If you're changing the tax structure for everyone in the whole economy, you're going to change the macro labor supply, which means that more people would go to work. That would push down wages, down pre-tax wages. After-tax wages may go up. And recognize that more people would work. Businesses might see some lower expenses because of the reduced wages. And they would account for all of these total changes together. So you would get feedback in output, feedback in labor, feedback in total prices, price indexes. You would open up changes across the entirety of the economy that could potentially have these economic effects. So currently, the procedure for dynamic scores are required only in certain cases of major legislation. Dynamic scoring, it's a time-intensive process. So not every bill has a major effect on the macroeconomy. Not every bill needs a dynamic score. So currently, within the House, it's required for anything that has a gross budgetary effect of more than 1% of GDP. It can also be asked for in cases where the chair of the House Budget Committee deems that mandatory spending is major legislation, or for revenue legislation, if the chair or the vice chair of the Joint Tax Committee decides that it's major legislation, then that can request a dynamic score. Yes?
Who determines if the legislation is going to have an effect of 0.25% or not on GDP?
CBO determines that.
And is it clear how they decide that or not?
It basically falls down on Phil Swagel, on the director, to make a determination once a bill gets far enough along in the process. Okay, you can do a rough estimate without going through the full process, and a ballpark estimate would indicate whether it would be significantly above a 0.25%.
That's very true. CBO does that scoring. But I will point out that I've been asked to run the numbers and to see whether or not the growth rate would change by 0.25% or the level would change by 0.25%. So member offices can go to other economists who have macro models similar to what CBO has and said, well, what do you think? And then you could, because sometimes CBO, maybe it doesn't really want to do it,
Mhm.
and so they don't find this trigger mechanism.
Again, yeah, you can take GDP, it's 28 trillion now or so.
Yeah.
So, I mean,
Give or take.
you can find out, I'm not going to do math in public, but you multiply by 1/4%, and then you can ballpark, here are the changes that we think. You are going to produce a static estimate, and if you are above that threshold or close to that threshold, you can say, hey, this is very clearly major legislation. This is not, it shouldn't be a major hurdle or like something where I always think of it like with replays in sports. You're supposed to go back and watch, like, did you cross the goal line? Was it nitpicky? Was it close? Did you see it? It should be a very clear thing where you go back and you see, okay, whoops, that was very obviously out, or you dropped the ball there. This is not a nitpicky thing. So you shouldn't need to worry about that kind of threshold. Okay, the debate. The argument on behalf of dynamic scoring is that for these cases where you're passing a tax cut to grow the economy, i.e. you're reducing the amount of revenues in order to increase economic activity, you should recognize that there will be increased revenues from increased economic activity. Very similar to the scorekeeping guidelines. The entire point of the bill is to grow the economy. So how can you give an honest assessment of the bill if you're not actually taking what it intends to do seriously? The argument against dynamic scoring is that the existing scorekeeping process reduces some of the contention among the different parties as bills move through. There are a lot of people that have a say in it, and so it is seen as, it's not perfect for everyone, but everyone can agree there's a very well-defined procedure, and you can apply that procedure very mechanically, and scorekeepers will all say, we agree that this score has these effects. Once you move to dynamic modeling, your dynamic effects depend very heavily on your choice of your economic model, which is much more contentious. It becomes easier to assume that you're going to get fantastic economic growth, and therefore say, look, this bill would pay for itself. It would have huge economic effects, therefore we can pass it right away. But without that objective procedure to give both parties trust in the process, it then becomes a fight as to whose model becomes more favored. So for now, conventional scoring has been the official arbiter for the process. Dynamic estimates are still produced, they're still helpful for informing the debate, but as far as enforcing the points of order in the legislative process, it still uses conventional scoring. But that's an option that can be put up for debate if Congress were to adopt dynamic scoring as a standard. Then CBO and JCT would have a procedure. There would be a long debate about what's the appropriate model to use, how would you include that, and if you can settle on a unified economic model, a consensus economic model, and a good procedure, then that opens up the possibility for using dynamic scores to officially be the scorekeepers in the legislative process. So let me show you an example, and then this is probably took a big screenshot from the document, but it's might be a little hard to read. So this is the dynamic score from the Joint Committee on Taxation following the Tax Cuts and Jobs Act. So they give a long discussion of how they modeled the changes, what they did, how they incorporated all of the parts of the legislative text, how they made it fit into the economic models, the economic effects. But it basically boiled down to this very streamlined table where they have the conventional estimate in the top. They include the changes in macroeconomic feedback. So basically, when they run their models, they count the differences. They run a baseline version of the economic model, they run an alternative version, and they can tell how much of a difference comes from incorporating these changes in labor supply, changes in investment, changes in capital supply that come from macroeconomic feedback, and they convert that to a dollar figure and just put that in the table. And so you can look at the 10-year numbers here. It's roughly 1.5 trillion under a conventional score and a little over 1 trillion once you in deficit increase once you include macroeconomic feedback. And that's about kind of what you can expect from getting the macroeconomic feedback. It reduces the cost by 20 to 30%. But of course, that depends a little bit on exactly what's in the law. So if you have a law that is focused on growing the economy, you can see large effects. The One Big Beautiful Bill Act had a dynamic score from CBO that had macroeconomic feedback that, if you pull it up here, is relatively small. So increase in the primary deficit of 2.4 trillion, feedback gets back about 350 billion. So it was a little bit smaller. But you can go look and find and see these published online on the JCT and CBO websites. Questions on dynamic scoring? Yeah.
So whenever you have like a bill that, say, invests money into the economy to grow it, does that also benefit from the dynamic scoring?
It depends on what the investment is.
Okay.
So that's where it helps to fall back in thinking like an economist and to say, so often within economics, investment is a purchase of capital that is used in production. There's private investment run by the private sector, but there's also government investment. So in different, like building out the highways. Highways are used in production, transport of goods and services. So if you have a bill that focuses on some type of investment and you want to reflect an increase in GDP, when you go to make a request of CBO or JCT, you need to specify that story. Say, hey, this is spending on some type of an investment. This is increased funding for this use in production. You need to capture this effect in production because that's why it's going to grow the economy. There's more capital available to be used to produce goods and services. If you're just passing off spending, something that is a one-time use, but you want to make it sound really good and you're calling it an investment, that's not necessarily an investment.
By the way, Parker, 1/4% of GDP right now is $77.7 billion.
Yeah.
And the tricky thing about 1/4%, because you make the calculation against nominal GDP, not inflation of GDP, is that the higher the nominal GDP goes, the higher the threshold is before you qualify for dynamic scoring. So maybe we ought to have another rule. I mean, maybe we ought to have a rule that says 150 billion or 30 billion or something like that.
Yeah, I mean, that is one of the points that we've tried to highlight from earlier in the seminar, that inflation it's the measurement, it's the yardstick for measuring economic activity. And so tracking inflation, being able to adjust these changes within the budget, within the economy for changes in the value of the dollar is absolutely critical. You need to understand when the cash flow that the government has is measured in dollar terms, but the economic effects and its relevance for the economy is measured relative to GDP strictly in real terms. The chart that I showed for the baseline earlier in the presentation it showed outlays and revenues not in dollar figures. The dollar figures are always going to go up because the value of the dollars is declining over time. But it measures outlays and revenues as a share of GDP. And you should reckon, I mean, the economy is supposed to grow over time. And so the government is going to grow in dollar figures to match it, but as a share of the economy, government should be roughly about constant.